Hallo mense, ma's se kinders. Al julle lekker mense daar buitekant. It's good to chat to you today. And we're going to chat today because it's Tuesday and we chat about financial planning on Tuesday. So last week I spoke to you and I gave you a little bit of a synopsis of the history of life assurance and how not life assurance, insurance, and how it came about. So today what I want to do is just branch out a little bit from there. And as I go along, what we'll do is we'll get more and more intricate into the various forms of life assurance. So what I wanted to touch on today is from the story I told you last week in terms of how insurance started. Let's now look at the different types of assurance that you get in the marketplace, okay? So on the one side, we've got what we call short-term insurance. Now, what is short-term? Short-term is anything whereby you pay a monthly premium and a said item would be covered. Now, the most common that people out there know is car. So you insure your car. I mean, that just makes sense, doesn't it? So you'll pay a premium of 800 Rand or 4.5 grand, whatever the case might be, depending on what car you're driving. You pay that, okay, every month. And what the insurer does is they say, well, we'll take on the risk that if anything happens, we will cover not only the value of your car, but you can even include in there any outstanding finance, okay? Short term is not only car, it's household. So household is basically everything you've got inside your house. So if you get burgled or if the house burns down, it's all your TVs and that type of thing. Then you get home owners, which also falls on the short-term side. Homeowners, commonly known, it's if your house burns down, it's not for the stuff inside, it's to rebuild the house. Okay, so on the short-term side of things, you also get splits. Okay, and the main split that you get is you get personal short-term, which is your car, your house, your cell phone, all that kind of stuff. And then the other split on the other side, you get something called commercial. Now, what is commercial? Not much different to personal, except that it has to do with the business. So even if you run a one-man show and you are Bob the Builder, like my good friend Henry down in the Cape, who does renovations on houses, he has commercial insurance. Because when he starts a project, okay, the project might be worth 200, 300,000 Rand. He needs to insure himself against something happening that would adversely affect him. Okay, so in other words, sky's the limit. Materials being stolen, his vehicle being in an accident, workers falling behind. You can insure anything on the commercial side of things. Fleet owners of trucks and motor vehicles, they would fall under commercial. But interestingly enough, when I say you can insure anything, you can literally insure anything. On the commercial side, you would have perhaps a ramp model, and a ramp model would insure her legs, or an eye model would insure her eyes or her facial features, a foot model, the same kind of thing. On the commercial side, let's give you an example that everyone will relate to, and that's rugby players. So a rugby player can be insured, and he is insured by his union against, guess what? Injury. Because when he's injured and he's not playing, he's not making money for the franchise. So that's where we get all our commercial stuff goes on that side. We will get into commercial a little bit later, and also expand on the personal lines. Okay, so that's the one side that you've got, and that is what we call, remember, short-term insurance. On the other side, you've got what we call in the market, that brokers like myself like to call, it's financial planning. Okay. And there what we look at is life cover. If you died tomorrow, would anyone be adversely affected by the loss of you stroke your income? Okay. Much the same goes under that category as well. You get disability insurance. You get severe illness insurance. You can insure against something happening to you and your children's education being taken care of. You can put a waiver of premium. So you can say, if I'm paying my retirement annuity, but if something happens to me and I get disabled or I get a severe illness, I want you, Mr. Old Mutual, Discovery, whoever, to pay the premiums on my investment until the investment either matures. So let's say it's an endowment and it's 10 years. They would factor in what the risks are and what the cost is to get to those 10 years, pay your premiums. By the same token, your retirement annuity, I do a lot of waiver of premium on my retirement annuities, and that would pay all the way to age 65. Where your income protection would then stop. Oh, did I mention income protection? You can get income protection. And you can have it all the way down to a 7-day waiting period. If you have a look, and as you know, I do specialize in doctors. If a doctor's off for 2 weeks, he's lost 2 weeks of billing. So we pay backdated to day one from 7 days. So the guy must be off for at least 7 days. Okay. So those are your two main sides. And as I say, so remember, on the one hand, you have short-term insurance. And on the other side, you have life assurance. Because what I'm going to do with the life assurance is I'm going to assure you, you're either going to die, become disabled, or retire. Okay? Something is going to trigger on that side. So we've got the short term on the one side, and we've got life on the other side. Short term is either personal or commercial, business. Life side is the same, either personal or business as well, because you can do what we call a contingent liability for someone that's very important in your business. So that's it for today, guys. I hope you found this interesting. If you did, please like and subscribe. You'll see the little thingy up here. And as always, God bless you. Let's stick away from all the fluff. Let's not sell the sizzle. Let's sell the steak. And most importantly, use the brain that the good Lord gave you and use it as intended. Use it for good.